Are the jobs numbers telling the whole truth, or is there more beneath the surface? Economist Mohamed El-Erian dissects the latest U.S. jobs data, addressing whether the numbers are influenced by politics, and if these revisions keep happening, what does that mean for the reliability of the data, and how should investors react next time the numbers drop?
Estimate quite a few things, and then as you get the data, you go back and revise it. So these issues have been there for a long time and have been getting worse. And there's been a sort of very reasonable discussion about what do we do to improve data collection. There isn't much evidence that they are politically driven, all this. It's just the nature of the exercise and the fact that the data collection tools have not evolved as quickly as they need to evolve.
Right. So clearly challenges, as we've discussed, low survey response rates, whatever, maybe the modeling of how you extrapolate the survey numbers to an overall estimate of activity. But there is precedent, I think, in other countries of people trying to massage the data. By the way, I think it's also important to note there are private sector sources of comparable data, right? We talk about the ADP report every month. It tries to get private sector payroll. So it would seem that there's everyone around the edges trying to triangulate these numbers. And so you would be able, in theory, to sort of check one against the other.
Yes, and it's really unfortunate because during COVID, we got very innovative when it came to estimating data. So we went from waiting for example, GDP data, which is really backward-looking and lagged, to looking at credit card data, to looking at traffic as other indicators. We have a lot of high-frequency data, and I think the sad news is that the official data collection process hasn't really taken as much advantage as they should from this high-frequency data that can make the revisions less violent. I mean, today, Mike, we've completely changed the view of the labor market. The revisions were so large that the 3-month average, moving average, came down to 35,000, which is the lowest number since 2021. So suddenly you've got a completely different view of the labor market over the last 3 months than you had just yesterday.
That is absolutely true. And as I was saying, it sometimes does happen when you have, real speed changes within the economy or inflection points. But, I guess maybe I'm enough of a believer in market wisdom or how markets react to things to suggest that, look at the dramatic 2-year note yield reaction to today's numbers and the downward revisions, right? We're down like 22 basis points in the 2-year note. That means that the market said, well, I guess this is new information or newly estimated snapshot of the economy, and we have to react to it. If it were not considered to be the best possible guess that we have available to us, markets would probably ignore it.
No, I agree. I mean, there's two things going on with the 2-year. One is where we've come from, and in particular, Chair Powell came across much more hawkish than most people expected on Wednesday, putting in doubt a September cut. So you had the initial conditions that led to a higher 2-year than would have been otherwise, and then you got not only a significant fall in the 3-month moving average of new jobs, but the unemployment rate is the highest since 2020. So, those of us who are arguing for a rate cut this week were worried about the underlying strength of the labor market. And where did we get that worry from? From talking to employers. Employers have become much more hesitant to employ people, and now it's starting to get picked up in the data.